We got new data regarding pending home sales, or pending sales of homes. Yeah, that's right. And it's down 4%. The Wizards of Smart told us it would only be down 1%. And I guess last month, or was it last week? No, I think this is a monthly measure too. It was down 4.7%. So pending sales continue to drop. Yes, you can say, oh, well, maybe it's inventory is dropping. That's why, because people really want to go out and buy homes, but there's just no homes to buy. You can make that case, but we're starting to see prices drop off. So I don't think it's because there aren't enough homes to buy. Sure, inventory is still pretty far down, but demand, as I've talked about before, is dropping even faster. So inventory is going to catch up. Inventories are increasing. That's why we're seeing now housing prices start to drop. On a relative, inventory is always a relative thing. It's not an absolute thing. You can't just say, oh, well, there's only so many houses on the market, so the housing market's tight. No, you have to look at that relative to demand. If demand falls off a cliff, which it has, I don't care how few houses you think there are on the market, it's still too many. They can't all be sold. And that's a good thing. We want to see more and more houses piling up. For those of you who don't follow George Gammon on YouTube, I recommend you all do that. He's a very good channel. Puts out, I think, very good videos that are... Sometimes I think he gets kind of in weird directions. But most of the time, I think that he's good at breaking down things quickly in a way that most people can understand who, are not educated in economics and who didn't, spend years reading really dense treatises on economic theory, or people who haven't, worked on Wall Street for 20 years, which I find his channel useful for that stuff, because the financial plumbing is something that I don't get. That's something you don't learn. It's not a part of economics. I mean, economic stuff I get pretty good, but as far as the ins and outs of how a Wall Street bank works, I couldn't tell you about most of that. But anyway, he's got a good video that went up yesterday on the current state of the housing market that I pretty much endorse completely. I thought he had made very solid points. It wasn't really anything, brand new if you listen to this channel or listen to other people. I think that there's amongst alt finance, there's not a consensus, but there's a general perception that yes, the housing market has begun to crater. It will take a long time to bottom, and the bottom will probably be somewhere near the historic mean. We're going to see housing prices revert to the mean, which is what any exchange-traded asset class should do in a real correction. Mean reversion is inevitable depending on who you ask. Typically, the people who argue that mean reversion is not inevitable are folks who are benefiting from a big asset bubble and have never been through an asset crash. From 1998 to 2006, or I guess it was around 2000 really that it started, but I think I won't get into the weeds. The housing bubble of the early 2000s took about 6 years to inflate. Housing prices rose significantly above the mean, above the long 100-year average, and then crashed precipitously. But as fast as that housing crash came, we have to remember it still took 6 years for the market to bottom, for it to really get back to that long-term average. So housing prices went from being ridiculously overvalued in 2006 to, well, let's start back in 2000. 2000, housing prices were about where they should be, historically. They were priced fairly. Then, over the next 6 years or so, you had a massive blow-up in housing prices. It peaked in 2006. Then, from 2006 to 2012, crashed back down to the long-term average. And so, those of us who have been watching the housing market over the past few years have been saying, well, inevitably, the housing market's going to do that again, because that's what it's done before. There's no real reason why housing prices, on average, across the country, should rise. It's not like we have this big booming population and a dearth of housing. There is no structural excuse for housing prices to never again revert to their mean. And so that means that we've been in a bubble, and at some point that bubble will pop. Well, now, I think we can agree, I think it's safe to say at this point, the bubble is being popped, or is in the process of popping. The air's coming out. It's over, but it's going to take a lot of time to come back down to earth. It's going to take years. And just like back in 2006, 2008, around there, the bubble was popped by the Fed hiking interest rates. This almost happened, as I've said many, many times, even back at the time, in end of 2018, beginning of 2019, but the Fed flip-flopped. We would have had the housing crash way back then. We would have had a housing crash going into 2020. We would be pretty close to the bottom now had the Fed not pivoted back then. We would be 3 or 4 years into a housing crash. But instead, we've got a bigger bubble than ever. And so that means that housing prices have a much longer way to fall in order to get back to that mean. But as George Gammon points out, that long-term average has to be adjusted for inflation. When housing prices went down from their peak in 2006 back to the long-term average, the average that had, that exists going back to like 1900, housing prices in 2012 at the bottom of the market were not where they were in 1905 nominally. Obviously, there's been an immense amount of inflation since 1900, 1905, 1910. The nominal prices are still up tremendously. And so, likewise, because we've had so much inflation over the past 15 years or so, particularly the last 2 or 3 years, even if we revert to the mean, nominal housing prices will still be much higher than they were way back in 2012, 10 years ago. Almost, well, actually, we're getting close to that. We're almost in 2023, so it'll be 11 years ago. And so, yes, we will have mean reversion, but instead of being able to buy a 3-2, 12 or 1,300 square foot house for $100,000 like you could in 2012, it'll probably cost like $150, $175 at the very bottom of the market, because that's just how much value the dollar's lost. And as we know, wages do not keep up with inflation. So the housing market is at the bottom of this market, let's say 6 years from now. Let's say we fast forward to the late 2020s, to 2028, and we're at the bottom, or let's say maybe 2029 at the latest. But no, 2028 is fine. By then, there will have been so much inflation, and your wages will have only increased so much. You're going to be in a worse position still to buy a home than you would have been back in 2012. And that's the sad reality. So, are things going to get better than they are right now? Yes. Are they going to be as good as they were back in 2012 when houses were actually affordable, relative to your income? No, but things in 2012 were still much worse than they were in the 90s. And, the 90s were worse than things were, in the 60s, and so on and so forth. Back, as I pointed out many times, back in the 1950s, on a minimum wage salary, you could buy a brand new home and not be stressed about money. Like, you could comfortably afford that working a minimum wage job in the 1950s. So even though housing prices are going to revert to their mean, they will not revert to the mean nominally, and your wages in real terms will not keep up with inflation. And nobody talks about that. Nobody seems to really care. Like if I were a politician and I wanted to, get people's attention, and get them to vote for me, that would be something that I'd talk about. That would be something that I would campaign against. Those were the kinds of things I'd point out, because I think that's something that pretty much every American, like, that's not a political thing even, but that's something that every American should be able to relate to. Hey, housing prices super expensive relative to my income. Even if housing prices come down, my income, because of inflation, will still not keep up, and so it just gets more and more unaffordable to live in this country. And wages are, housing prices should be, in theory, a derivative of wages. If wages don't rise, housing prices shouldn't rise either, yet they have. And even at the bottom of the market, when interest rates, when the interest rate effect on housing prices has been minimized, we're still not going to see housing prices adjust to where they should be relative to income. Now, why is that? The answer is that to the extent that housing prices are not a function of the income of workers in a given community, that means that the demand for housing has to come from some other source. The money that people are getting to spend on housing must come from a different source than just working in that community. Let's say you're in Walla Walla, Washington. If the average household income in Walla Walla, Washington is only $30,000 a year, well, then you would expect housing prices probably to be relatively cheap in Walla Walla, Washington, because on a $30,000 a year income, you can't afford to pay much for housing. But if we look, and I'm pulling these numbers in this town completely out of my head. If you looked at Walla Walla, Washington, and you see, the average sale price in that community is actually $750,000, that would make you scratch your head. Because obviously the average income earner, the average household making $30,000 are not the ones buying those houses. It has to be outside money. It has to be money coming from a different source than income from working in the community. And that's certainly the case here in Florida in most of the, at least the growing markets. And so broadly speaking, there are two explanations for this. One is, you could say, remote work. Remote workers, because of 2020, were able to move wherever they wanted in the country, and so people, making these six-figure salaries working for tech giants could move into small-town America and bid up the housing prices, like what we saw in Boise, Idaho, the ridiculous real estate boom in Boise, Idaho. All of a sudden, everyone who lived in Boise couldn't afford to live there anymore, and a bunch of Californians moved in. That's a more recent and, I think, less long-term trend. It's something that I don't think has staying power. The remote work, movement. I think the companies have mostly reined that in because they find that people are less productive when they're not in the office in a cubicle, supervised, by some jerk in a shirt and a tie. But what you really have to worry about are people moving into your community who are paying for those houses with money obtained because they owned appreciating assets. In other words, you have someone who owns a bunch of stocks go up 3,000%, and then all of a sudden this person has a bunch of money, they go down to Florida, and they spend, $2 million, on a 2,000 square foot house on a quarter-acre lot, and you go, oh my gosh, who would pay that much for that kind of house? What are they making? Well, at the end of the day, if your stock portfolio goes to the moon, you can afford to pay a lot more than you would if you were just living off of your own income. And of course, the gains in the stock market are concentrated in the hands of a very small number of people, and that money can flow anywhere in the country that they want it to. It's not limited to where they happen to be living at a given time. If you have a bunch of people living in New York, for example, who made a bunch of money because they invested in assets, and those assets appreciated significantly. They don't have to spend that money in New York. Whereas if you're spending your money, if you're spending money that you earn through income, that income, you only have that income if you stay in that community where your job is. If you leave the community and move somewhere where housing prices are cheaper, you also are leaving your job. And so you'll have to find another job, a job in that given community. And so therefore, your demand for housing will be about in line with everyone else's. So where am I going with all this? What does this have to do with the disconnect during a housing crash between real incomes and the real cost of housing? In a housing crash, you probably are also looking at a stock market crash. And therefore, if stocks and bonds and whatnot, if everything crashes along with real estate, as hard as real estate, then that added demand in the housing market that came from asset price appreciation disappears. And all of a sudden, now real incomes go back to being the source of demand in the housing market. And furthermore, when interest rates rise and you can actually make a real yield in the bond market, there's a lot less demand from real estate investors. And so you don't have these institutional buyers or even small-time real estate investors that maybe own less than 10 or less than 20 properties competing with you in your local housing market. And so therefore, there is a chance that housing prices do come back into sync with real incomes. But knowing our government and the Fed, they will do everything they can to create another asset bubble or to keep the current asset bubble from truly collapsing as much as it should. But nevertheless, as long as there is some kind of big crash for Wall Street, that is going to help you in the housing market. But the extent to which, I'm still unsure. We'll have to wait to see where stocks and bonds bottom out. Because if you have a bunch of investors who all of a sudden take a haircut on their assets, they're going to be a lot less likely to go down to Florida or to North Carolina or Idaho or Texas and buy a second home, or just move completely and live there, quit their job, and live off of their investment income, living in Austin, because that investment will be greatly diminished. So to sum things up, we are turning a corner in a good way. Things are going to get better as far as I'm concerned. There will be people, there's going to be economic chaos. But we'll be moving in the right direction. It will be, kind of a no pain, no gain kind of situation. So this is the good kind of pain. And so the question at this point is, how much relief are we going to get? How much are housing prices going to come down relative to income in your local community wherever you live? That to me is the big question, more so than housing prices in so-called real terms, because real terms, what affects? How do you adjust for that? Well, you use the CPI. Well, we've already talked about plenty of times how the CPI is not an accurate measure. What matters is the cost of a house where you live relative to what you're able to make working in your community. So, with that said, I will see you folks back here tomorrow.